Hello, I'm Ravi Dave, CEO of Yankee Capital Partners. I want to thank you all for taking the time to join us as we present our new YCP fund. We are currently accepting investors in the fund for a limited time. Hopefully after this presentation, you will join our investor family. Today we will go over the new fund specifics, our proven strategy, why multifamily apartment investing is essential for any investor, and how you can benefit by partnering with us. Let's jump in. Yankee Capital Partners is a multifamily real estate company focused on acquiring and managing B-grade apartments in fast-growing markets. I founded Yankee Capital while working in private equity, where I saw strong demand for multifamily housing by institutions and high net worth investors. I later asked my Babson College friend, Edward Sarkeesian, to join the company and bring his years of multifamily construction and operational experience to the team. We implement a value-add strategy consisting of select capital expenditures and operational efficiencies to increase revenue and rental growth. We pull individual accredited investors together to invest in institutional grade assets which they wouldn't be able to purchase on their own. Our focus is on properties that are 85% occupied and are cash flow positive from day one. We focus on select landlord-friendly metropolitan cities experiencing growth levels above the national average. As of February 24th, 2021, we have launched YCP Value Fund 2. Our fund has a goal of raising $10 million to acquire a single 150 plus unit B-grade apartment complex in select markets with a price range between $15 to $30 million. We use a data-driven approach to pinpoint locations within specific markets that will continue to outperform the rest of the US, which we will go over today. Investors in our fund are limited partners who will have passive ownership of the apartment complex we purchase. You will have no day-to-day management responsibilities while enjoying a 7% preferred return through the cash flow of the property. And you can expect a 13 to 18% per year total return over the property's holding period. Let's go over why we believe in this asset class so much. Real estate investing is crucial in building a diversified and stable portfolio. Many investors might not be aware of the performance of multifamily apartments relative to other alternative asset classes. This chart shows that apartments are one of the best performing asset classes compared to bonds and other safe alternative asset classes. On this chart, you can see that core commercial real estate as an asset class is actually the second safest investment on a risk-adjusted basis behind government bonds. When comparing it to other asset classes, such as large and small cap stocks, it has a lower annualized risk and higher total return. Within core commercial real estate, apartments are the best performing asset class over the historical average. A key question many of our savvy investors ask is, how does adding commercial real estate to my portfolio make a difference? This chart shows how direct multifamily real estate has outperformed the S&P 500 by more than 60% since 2000. Using the 20% rule, where 20% of your portfolio is invested in alternatives like multifamily real estate, you can earn greater returns and a reduced volatility. Investors who invested using the 20% rule have earned about twice as much as investors who use a more traditional allocation. Our fund's focus is on the middle class, blue-collar Americans who represent the largest stable rental pool. These are people who are attracted to the transient lifestyle and short-term commitment in renting versus home ownership. This provides investors with higher rental growth upside and lower downside protection in rent collections. The other trend that we will continue to see that makes multifamily a very attractive asset class is rental pool growth. We are seeing less and less people who want to own but cannot afford to own a home because of the down payment. The millennial generation are happy to be renters for more extended periods, and baby boomers are downsizing or selling their homes. We see current COVID-19 trends of buying single-family homes is comprised of an affluent segment of the population, with incomes of $80,000 and above. Most of the blue-collar renters can't afford to buy a home and will likely continue to rent for many years to come. Our fund's target markets are Texas, Georgia, and North Carolina. While there are other macro population trends in certain metros in the country, there's a large population shift towards these three states. The continued population growth in these states is fueling the unmet supply of multifamily housing. The shift is occurring due to lower cost of living as well as economic growth. Current supply of housing is meeting the upper end of the pool, thus giving us an enormous opportunity with our strategy to meet the increasing demand. Continued Fortune 500 company relocations are driving employment growth in all of our target markets, as more and more people are moving to find better job opportunities. As you can see on these charts, all three states are well above the national average in their respective cities. People are moving there faster in search of better opportunities for themselves and their families. While these trends provide a safer place to invest, we continuously search key submarkets in these areas to make sure we find the best areas for investment. As you can see in this example, Texas is having a major boom in economic growth. More and more Fortune 500 companies such as Tesla and Oracle have relocated to the Lone Star State because of its business-friendly policies. To further understand our strategy, let's review the classes of multifamily and start with the definition of multifamily. Any building that has 2+ units is considered commercial multifamily. Within multifamily, there are 3 grades, A, B, and C. We focus on Class B apartments. By being positioned in the middle, we feel confident our asset will perform in any part of the economic cycle. We focus on B-grade properties of 150 units or more. By focusing on a large number of units, we can take advantage of the economies of scale that come with the larger property, such as reductions of costs when improving the property and management fees. Larger properties also have lower occupancy risk. For example, 1 vacant unit in a 5-unit building is at a 20% vacancy, whereas 1 vacant unit in a 100-unit building is only at 1% vacancy. Another highlight is that demand is projected to increase as construction costs only move higher. Developers are focusing on Class C construction and chasing returns. We can take advantage of growing demand in B class by repositioning and upgrading properties. In addition, we focus on properties that have some maintenance needs but are more expensive to rebuild. This allows us to identify projects in strong submarkets and bring the property's offering and appeal up to modern standards. Our fund is set up to raise money in advance of finding an asset for investment. The fund has strict guidelines for the type of asset and return metrics. A traditional fund or syndication process is to follow the model of securing a deal and signing a letter of intent, which forces them to raise equity in a very short period of time. Sellers treat syndicators as secondary buyers since they may not have secured all the equity and are therefore at risk to not close the deal. With syndicators not being able to raise funds, they are also at risk of losing hard money deposits and their reputation in the marketplace. Our approach is different. By raising a fund and having committed equity in hand, we can show sellers we are in a stronger position to close on a property, sometimes even with a lower offer. Having the funds upfront also allows for better deals and negotiations for both on and off-market opportunities. By raising funds upfront, brokers and sellers know we are a ready buyer who can execute and have the funds to close. With our specific focus on what to look for in a property, you can be rest assured Yankee Capital will provide the best deal for our investors. Our investors like to visualize the investment life cycle. During the first 4 to 8 months, we will be raising funds. We require investors to place an initial 10% deposit that is earning 3% annualized while we secure a deal. During the later part of the funding period, we will start sourcing opportunities that meet our criteria. Once we secure a property, we will present the investment to our investors and provide a supplemental investment overview for the deal. At this time, the remaining 90% of your commitment will be called to fund the investment. Once the property is secured and our funds are committed, we have 90 days of due diligence to perform on the property. We work with our lender to thoroughly inspect the property physically and financially. The lender also requires third-party inspection reports for appraisals, environmental reports, and a physical needs assessment, as well as a manager analysis on ourselves. Due diligence by both parties ensures no stone is left unturned. Once we acquire the property, we will implement a variety of capital improvements. This can consist of light to modest renovations, including the painting of the property, replacing roofs if needed, and setting up a rehab program to replace cabinets and fixtures. We will execute our financial underwriting and operational budgeting that we presented to our investors in the supplement. In the final years of ownership, we will drive organic rent growth with our property manager and attend to any maintenance issues the property may need. The goal is to drive net operating income as high as we can to maximize value. At the end of our life cycle, there will be a sale or refinance, otherwise known as a capital event. If we sell, we can roll the income and proceeds over to a new investment and defer a high tax bill, or sell and incur a tax bill. We can also refinance the property at a much higher value and continue to collect passive income. Returns are the central focus for our investors. After the investment life cycle of collecting quarterly returns from the property, investors need to understand our fund's potential returns after a capital event. Once we have a capital event, net distributable proceeds from a sale or a refinance first go towards catching up our investors in years that they did not hit a 7% return. The remaining proceeds are split between the investors and the manager. Another aspect of the fund's returns is depreciation. Our tax strategy for the fund will ensure use of all available tax structuring to maximize depreciation for income tax deferral and long-term tax reduction for the fund. Here, we have a potential return example for a $100,000 investment into the fund. In this example, we have reached a capital event or sale in year 7. You can see that the yearly cash-on-cash return, or net distributable cash, grows year over year to 9.2%. The potential returns are just under $50,000. The rise in income on the property prompted a sale. From the sale of the property, investors are first caught up to the 7% preferred return on years that they did not receive them based on the cash flow of the property. This, combined with the equity from the sale, totals $55,500. The gain with yearly returns totals $104,350 on top of their original $100,000 investment. A big area of focus for investors is understanding the company operating their investment. At Yankee Capital Partners, we have a methodical approach to selecting which properties to buy. We execute and deliver results with our internal team as well as our outside vendors. Since we are a younger organization, our goal is to align ourselves with our investors. We are looking for people who will continue to invest with us for many more opportunities. We stand behind what we say and do by investing up to 10% alongside our investors. Our management team background is in real estate, construction, and finance. We have been working in various areas of real estate for many years. Government-backed lenders and other institutions have vetted us. Over the years, we have worked to finance over $100 million worth of commercial real estate and managed $50 million worth of construction projects. We currently own and operate a 168-unit complex in the Dallas area. The process to build our portfolio can be recreated in all states that we target. We have worked alongside many real estate investment trusts and top property management companies. This has allowed us to bring the same level of professionalism to all of our investors. The YCP team is comprised of myself, Edward Sarkeesian, and Alec Randall. Eddie and I met at Babson College years back when we were studying finance and entrepreneurship. My experience stems from real estate finance and brokerage. After college, I worked for several years as a commercial broker in Dubai before attaining my master's in real estate development. What triggered my focus in multifamily was working for a private equity fund lending on all commercial real estate types, including multifamily, offices, and industrial. While I was working there, I underwrote hundreds of investments, and our company financed many different kinds of projects. From my time in private equity, I discovered the most sought-out investment in real estate was multifamily. After leaving private equity, I founded YCP. In the early stages, I spent many months reviewing hundreds of opportunities, conservatively bidding on only a handful of properties, and then finally acquiring our first property in McKinney, Texas called Ashton Oaks. During that time, Ed joined the company. He oversees asset management and construction management. He brings in a wealth of business and construction experience working with many REITs and private property management companies in the area. Using his expertise, we were able to secure construction teams, provide faster project completion, and be able to rent unit turns above industry standards. Last year, we expanded our team with a new hire, Alec Randall, to take care of client relations and help with reporting and marketing. Alec's previous experience was in investment banking, advising institutional investors on equity investments. Together, we oversee the entire investment lifecycle, from acquisition, management, and disposition of assets. Our existing property, Ashton Oaks, was acquired in 2018. It's a garden-style B-grade property consisting of 168 apartments. Our strategy has been similar to what we are planning with the fund and can almost be seen as a case study. Currently, the property is at 94% occupied, with 70% of the tenants renewing. This speaks to our effective management on retaining residents and our changes to the property. In our business plan, we underwrote painting the property, renovating the clubhouse, and adding backyards and upgrading balconies. We also implemented a unit upgrade program for most units consisting of kitchen and bathroom renovations. The typical premium we've been receiving ranges between $110 to $180 depending on the type of renovation. If you multiply this mix by 168 units on the property we budgeted to renovate, we will get roughly $250,000 amount added to the revenue line on a yearly basis, not accounting to about a 2 to 3% organic rent growth we had budgeted. By driving revenue up and decreasing expenses, the value of the property increases. We acquired the asset for $19.8 million and projected that in year 7, we will exit and sell conservatively for $30 million, providing our investors between a 15 and 18% return. When we took over the property, many areas needed to be addressed. Our internal construction team is excellent on value engineering and providing costs under our budgets, thus increasing our investors' upside. The first area was upgrading balconies and building backyards with a premium. The second area was building pathways through the community. Our third area was addressing unit renovations. We started with opening up the kitchens, installing new flooring and paint. In addition, we addressed countertops and new plumbing. Overall, the projects are coming along great at the end of year 2. One of the biggest worries investors had during the pandemic was how multifamily will perform as an asset class. As you can see in this chart, our property fared better than the national average in rent collections. Overall, multifamily performed above other asset classes. We value this data since it shows how substantial your investment can be in uncertain times. As they say, location, location, location. We focus on markets that we have identified as having strong fundamentals such as population and employment growth outpacing the rest of the U.S. We keep a disciplined budget when looking at deals and have select proven metrics that we follow to keep us within our business plan and investment thesis. We review income, crime, schools before we look at the property financials. We underwrite conservatively from the bottom up. Our goal is to underpromise and overdeliver. Our data-driven analytical approach allows us to locate investments that have a limited downside risk while having a strong upside potential. To ensure our goals are aligned, Yankee Capital co-invests up to $1 million into the fund as limited partners alongside our investors. We feel our investors must know that we have skin in the game. Our goal is to build generational wealth for your family by delivering results, and we have material incentives to do so. By investing with us, you are a limited partner in an LLC that owns the property, representing your fractional ownership of the physical asset. We pride ourselves on being transparent, trustworthy partners with our investors, providing detailed quarterly updates with financials, so you always know where you stand. Your ownership in the deal is 100% visible. To get access to investor documents, please go to investors.yankee-capital.com. Here you'll have access to our private placement memorandum, subscription materials, our fund deck, and the video you're seeing now. Our minimum investment is $75,000, and we offer discounts on the following levels. If you want to learn more, please feel free to schedule a call with any one of us. We thank you for your time today and look forward to you joining our investor family. Please feel free to reach out to any of our team members.